September is here, and if you trade QQQ or SPY, this month could make or break your strategy. The jobs data, inflation reports, the Fed's rate decision, and tech earnings are all driving sentiment. In this video, I'll break down the key macro events this month and how they could shape your trades and investments. We start the month with Non-Farm Payrolls or NFP. It is a monthly report that estimates the net number of jobs gained in the US in the previous month, excluding those in farms, private households, and non-profit organizations. It is usually released on the first Friday of the month. Historically, a weaker NFP print pushes markets higher because traders expect Fed cuts, while hotter jobs data does the opposite. The latest US jobs report shows the economy added just 22,000 non-farm jobs in August, with unemployment holding at 4.3%. On its own, that's already a weak print. But the real shock came from the benchmark revision. The Bureau of Labor Statistics quietly cut an estimated 911,000 jobs from the prior year's totals, meaning job growth was nearly half as strong as originally reported, averaging just 71,000 jobs per month instead of 147,000. For markets and policymakers, it raises tough questions like, is the economy cooling faster than expected? And does this shift the path for interest rates? Then came the CPI data. The Consumer Price Index or CPI is the most widely watched measure of inflation in the US. It tracks the average change in prices paid by consumers for a basket of goods and services, things like food, rent, gas, and healthcare. When CPI comes in hotter than expected, like it did in August, with a 0.4% monthly jump and 2.9% annual inflation, it signals that prices are still rising faster than the Federal Reserve would like. For markets, this data point is critical. Higher inflation means the Fed is less likely to cut interest rates soon, which usually pressures stocks, especially growth names, while pushing bond yields and US dollar higher. On the flip side, if CPI comes in cooler than expected, markets often rally on hopes of easier monetary policy. In short, CPI doesn't just tell us about grocery bills, it sets the tone for Wall Street's expectations on rates, risks, and economic growth. Next up is retail sales. The retail sales report measures how much people are spending in stores, restaurants, and online, and it's released once a month by the Census Bureau. Because consumer spending makes up about 2/3 of the US economy, it's one of the most important gauges of economic health. For the Fed, this report is key. Strong sales mean demand in the economy is still high, which can keep inflation pressures alive and make the Fed more cautious about cutting rates. Weak sales, on the other hand, suggest households are slowing down, which could push the Fed to consider easing policy sooner. And since this data often lands right before the Fed meetings, it can heavily influence how markets price in the next rate decision. Then comes the big one, the Fed's September meeting. The FOMC meeting is when the Federal Reserve sets interest rates and updates its outlook on the economy. These meetings happen 8 times a year, and the decisions made here ripple through every part of the market. If Fed signals that rates will stay higher for longer, it usually pressures stocks and keeps borrowing costs elevated. If the Fed hints at cuts, markets tend to rally as investors expect cheaper money and easier financial conditions. Because this meeting comes right after the latest payrolls, inflation, and retail sales reports, traders will be watching closely to see how the Fed interprets the data. Even if they don't move rates, the tone of the press conference and the updated economic projections can drive big market swings. To close out the month, we'll get the Core PCE report, the Fed's preferred inflation gauge. The Core PCE price index is the Fed's preferred measure of inflation. Unlike CPI, which looks at a fixed basket of goods, PCE adjusts as people change their spending habits and covers a wider range of expenses. Core means it strips out food and energy, which tend to swing around a lot, so it gives a cleaner picture of the underlying inflation trends. This report comes out once a month from the Bureau of Economic Analysis. If core PCE stays high, it signals inflation is sticky, making the Fed more cautious about cutting rates. If it cools, it strengthens the case for easier policy. Because the Fed watches this number so closely, markets often move sharply when the data hits, especially if there's a surprise versus expectations. So that's September in a nutshell. Jobs, inflation, retail sales, the Fed's rate decision, and core PCE all packed into 1 month. Each report tells us something different, but together they paint the picture of where the US economy is heading and how the Fed might respond. For traders and investors, this means volatility. If the data shows inflation is still sticky and the job market remains tight, the Fed may hold rates higher for longer, which tends to weigh on the markets. But if we see signs of cooling, weaker payrolls, softer inflation, slowing retail sales, it could open the door for a shift in policy and give markets some relief. That's all for this month's macro breakdown. Thanks for watching, and I'll catch you in the next one.